Hi everyone, hope you're all doing well. Today I'm going to talk about a new stock I bought. Actually, I mean an ETF, I know. Unbelievable, isn't it? So apologies that this video is a little bit late getting up for you guys. I didn't feel too well on the weekend, and I thought today I'm going to get this video up for you. I'm powering through it. Going to get this video done for you guys. But today I'm going to talk about a new ETF I bought, and I know, individual stock picker, that's what I'm normally at. But with this opportunity right now, I'm seeing a once in a decade opportunity. This opportunity in this index rarely happens. The only time it happens is once every 10 years. And for me, I'm looking at a really good, solid index that is half the valuation it historically is at. And for me, that's imagine the S&P. Imagine you could get the S&P 500 at half its value. You'd buy that opportunity. And this index and this ETF is actually not too far away from what the S&P 500 is, and its historical returns are very similar. So I'm looking at this opportunity thinking, I've got to buy it. And I've also had the great kind of last few weeks where obviously the portfolio has been flying in the last few weeks. It's been a really good end to the year, and I've had a lot of stocks that have been sold. You look at Revolution Beauty, sold that for a really good profit and freed up another stock position. We had the likes of Pinterest that went, Gang got bought out, obviously not for a profit, but was bought out and there was cash from there. We had the likes of Hotel Chocolate that was bought out, and we made some good money on there that I can use. So, and also I sold a 10% position, or trimmed my position in DraftKings by 10%. And the combination is that it's been a while since I've had this much cash on the sidelines. The last 2 years I've just been buying and buying and buying, and now with the stocks that have been going up so much and selling a few stocks, I've actually got a decent cash balance on the sidelines. And I was like, I've got too much cash. I need to get some of it in the market. And I looked at this opportunity and I thought, this is an opportunity here that we only see once every 10 years. So, I can buy a really quality ETF here, take advantage of it, and that's what I'm going to do. So I'm going to tell you what that is in a second. Also, this was the mystery stock on the Stocks I'm Buying series. I listened to you guys and your opinions on that, and I agree. I am still going to show you guys every stock I'm buying and selling on the YouTube channel. I know I said that I might keep it behind a paywall going forward, but then listen to you guys and your thoughts is that I've always kept up the transparency with what I'm buying, what I'm selling. So I probably should do that going forward. And even though it probably would be financially better for me to hide it behind a paywall, I'm not, because that goes against everything that I've kind of preached in the YouTube channel in the last few years, which would be wrong. So just thought I'd let you guys know on that one. Anyway, but let's get started on to this brand new ETF in the portfolio. And as always, if you do want to know what I'm buying and selling in real time, the place fees on Patreon, join through the link in the description. £5 a month, the price for a pint. And on there you get 2 exclusive videos a week. Actually, I think we dropped 3 last week, and I think we're going to do 3 again this week as well on the Patreon. So yeah, for the live buy and sell alerts, the exclusive videos, you also get a Discord with me and other members on to talk about stocks as well. Not bad at all. That's probably why it's the highest YouTuber to Patreon subscriber count on this stock market scene on YouTube. So something I'm proud of. So if you do want to support the channel, go support the channel for sticking around in that bear market and giving you all this content for free. Now, the brand new ETF into the portfolio is the S&P 600. So you guys know I was considering either the 600 or the Russell, and I've gone with the S&P 600 in the end. Now, the S&P 600 has basically had 3 years of doing nothing. If you actually look to the start of where 2021 was, we're nearly towards 3 years where it's done nothing. Actually, it's down 5% since that time frame, and since all-time highs in 2021, it is still down 17%. Now, it is the index that is the smaller caps, as you can see here. I'll probably get a few questions on this, but sometimes a few people, I've got a range of audience members. I've got some investors that have been in the market 10 plus years that watch my channel. I've got some investors that have been in the stock market for maybe 2 days that watch my YouTube channel. And some of you guys may not realize you cannot actually buy the S&P 600 or the S&P 500 directly. You have to buy a ETF that is a equivalent or a tracker of them, the index that you're trying to buy. So I'll get a lot of questions which one I'm actually buying. So the one that I'm actually buying is the iShares S&P Small Cap 600. So that's what I'm buying, just for the people that are asking the questions about that, because I'm sure there'll be a few in the comment section. Now, obviously there is the 600 holdings here, which you can go on Wikipedia and you can have a look through them all if you want. I'm not going to do that for you today, because you could go do that yourself. But if you look at the S&P 600 and then compare it to the S&P 500, they normally track pretty much in line. If you look through history, they've normally been in line. And then you can see here that they was a little bit of a divergence in 2020. We got back to where we were, and then we kind of had a little bit, the downtrend in the S&P 600 happened a bit earlier during 2021, and then eventually the big tech did join in. But this year in particular, we've seen the rally out from the S&P 500, but not from the S&P 600, which is crazy, because if we're not going to be, normally the S&P 600 is a little bit more sensitive. The smaller caps are normally sensitive to any downturns or upturns in the market. So when we had the downturn in the market, the S&P 600 felt it first. But this has been different. We've kind of come out, and the S&P 500 has reflected it, but the S&P 600 hasn't, which is strange. And then when you start looking at the valuation of what the S&P 600 is, so if you look at the S&P 500, it's currently about 18 times earnings. And if you actually look here, we'll look at the historic valuations on a P basis of these indexes. But if you look here, for example, the S&P 500 trades around 18 times earnings. That's about historically right for it. When you look at the mid caps and the small caps, which is the most important one that we're looking at today, it's currently 13 times earnings. Now, if you look at the moment, the only time this has been this low is during the 2008 crash and in the CV crash. Now, when we had the crashes and we bottomed out, when it was this low, you can see automatically the 600 did not stay down at this range for a long time, and then went back up to where it historically trades at, which is about 18. The last time that it was down here in the CV dip, once again, recovered very quickly back up to here. So this is only the third time that the S&P 600 has been this low on an earnings basis. And then when you compare it to the S&P 500, the S&P 500 is this red line here, as you can see here, and the S&P 600 is the green one. Normally, the one that trades at the highest premium is the S&P 600. So not only is at the moment there a massive gap of where the S&P 600 should be trading more in line with the S&P 500, it's also historically the third time it's been this cheap on an earnings basis, and last time it was this low, we saw the rebound, as you can see here. And also historically, when the S&P 500 is its normal valuation, the S&P 600 normally trades its normal valuation as well, but also at a premium. At a premium, guys. So if the S&P 500 is currently 18 times earnings, we should be talking about the S&P 500 at 19, 20 times earnings. And look, this is the only time, look at the disconnect here between these two. So I'm looking at this and thinking, well, either the S&P 500 is going to pull back, which I don't think it will do, because it's about right for the valuation that it normally trades at, or the S&P 600 has to have a bit of a catch-up. Now, the only big things, the big issues towards the S&P 600 in the next few years is going to be around the economy. If we do have a recession next year, then this is going to take a tumble. And if it does take a tumble, then I will buy some more. I bought about half my position now, and I will buy my half of another position if we get back to the kind of lows down here. But we were talking about where a lot of these companies will be trading at the levels they're at in 2020 time, and we've seen how many companies have increased their earnings since 2020, so that wouldn't really make sense for it to go that low. But if it does, I'll buy some more, and that will happen if the economy does hit a recession, which I don't think it will do. But if we do, then that's what I'll do if that scenario happened. What I think is that if we look at a lot of small cap companies at the moment, I think that a lot of them are priced incredibly historically low. And if we are going to have a year next year where we go out of interest rates are going to be consistent or even decline, that's going to be very good for small caps, that they know their interest rates. If we have an economy that carries on growing, obviously that's going to be really good for the small caps. And when investors are looking at the moment and go, you know what, I could go buy the S&P 500 that is currently trading at the average valuation that it normally trades at, I don't know why investors would go do that if we have a good economy and the economy's growing and the inflation's coming down, the Fed are holding interest rates or even declining interest rates. I don't know how much more that investors will go and buy the S&P 500 until they look at the S&P 600 small caps and go, shouldn't we really be buying that? Because that's historically low. And I think if we do hit a decent economy next year, then we will see the rally there, and that's where I see the opportunity. So for me, I look at the S&P 600 right now, and I'm looking at this thinking, I'm buying an index that is at the lowest it's been. It's only been this low twice in 20 years. And the last two times it was this low, obviously, you know, you'd be very happy to have bought them. And if we could zoom out a little bit lower on the S&P 600, if you did buy in the 2020 dip, you're up 63% on an index as well. You know, an S&P index, an ETF, which is, in my opinion, relatively safe. That I don't think we would get that historically that many chances to buy it. And the other thing is that it actually was only created in, as you can see, 2009. But if you were bought in 2009 and then held it through the next bull run, for an index which you can easily sleep on overnight and get a nice dividend yield, and then hold it, and then in the next 10 years get a 275% return, I think that's a fair amount. I think if I'm getting a once in a 10-year opportunity to buy an ETF, and I know I normally focus around the individual stocks, and obviously this will only be a small holding in my portfolio, but I think it's a great opportunity to buy a index, an ETF that is at historical low valuations that only comes around once every 10 years, and I think it would be a good addition into the portfolio, where it's a position that I just buy and sleep on it and hold forever. I don't really need to do much work on it, and I think it's a good addition into the portfolio, really. So yeah, I thought I'd buy that opportunity anyway. So hope you enjoyed the video and with me sharing this with you guys. I'm going to go now because I can feel my voice starting to go. But thanks for watching, guys. If you could hit the like button, if you're not here, subscribe, and I'll see you in a bit.